Boom! What's up, my Investomaniacs? Your boy Knight Rider here, and today is the day we go over the history of and current holdings in my $270,000 stock portfolio. Here was my portfolio on December 18th, 2017. It had 22 positions and was mostly large cap tech stocks like Facebook, Amazon, Google, Netflix, Apple, etc. As I better learned to value stocks and felt more comfortable with higher levels of risk, I slowly traded in these positions for mid-cap tech companies with a lot more growth, as well as decreasing the overall number of holdings in my portfolio. As you can see in my portfolio about 16 months later on March 8th, 2019. In subsequent months, I've sold off Tableau, Dexcom, New Relic, Proofpoint, and Splunk, and purchased Shopify and The Trade Desk. Currently, my portfolio consists of 6 roughly equal weighted names: CyberArk, Etsy, Roku, Shopify, The Trade Desk, and Twilio. Now, financial advisors would say, this isn't a diversified portfolio. This is too risky. Well, you know what?
They know nothing!
Because investing is all about your personal goals and your personal risk tolerance. I don't want $1.6 million when I'm 70 years old. I want to be rich. But if your objective is a secure retirement, you may opt for a more conservative portfolio. Now let's talk about the positions. You'll hear me talking about top-line growth, being in a growing industry, being a platform, and valuation, as these are the most important aspects to my investing preferences. Up first, cybersecurity company CyberArk. The global cybersecurity industry is predicted to grow 12% annually through 2024. CyberArk is a strong player, growing the top line roughly 30% annually. Plus, it's profitable and only trades at 85 times earnings. Up next, Etsy. Etsy is the de facto platform for independent businesses to sell their handmade or unique items online. Amazon is the only real would-be competition for Etsy, but Amazon already tried and already gave up, giving Etsy a strong hold on the market. Etsy is currently growing the top line at roughly 40%. However, part of that is due to a one-off increase in seller fees. Starting in Q3, that growth should be reduced to the high 20s to low 30s. Etsy is profitable and has a fair valuation at 67 times earnings.
Bye!
Up next, Roku. Roku is in the over-the-top video streaming business, and that industry grew 15.2% last year and is projected to grow 8.8% annually through 2022. I strongly believe traditional cable will die. And my favorite way to play that bet is Roku. Roku is a platform. So Netflix, HBO, CBS All Access, Hulu, Amazon Prime Video, Disney Plus, etc., they all live on the Roku platform. Roku is also a leader in this space, with more than 1 in 3 smart TVs sold in the US being powered by Roku OS. Roku is growing the top line over 50% annually, and that growth is actually accelerating. Now, I know what some of you guys are thinking. Amazon, Google, and Apple, they're gonna destroy your little Roku. Is that what you think?
It doesn't matter what you think!
Because Roku is a winner. Up next, Shopify. While Shopify has many competitors, when it comes to e-commerce for small business, Shopify truly is in a league of its own. Much like the iOS App Store and Google Play App Store, Shopify has its own app store for third-party developers to sell their apps to help you build a better website. The power of a high-quality and dominant app store is nearly insurmountable. The valuation does concern me, however. Although the top line is growing around 50%, operating margins are at negative 9%, which is worse than 5 out of the previous 7 years. The stock is trading at 33 times revenues as well, which is very expensive. Up next, The Trade Desk. Online advertising is and will be a quickly growing space for many years. The Trade Desk helps pair marketers with websites. But the Trade Desk isn't just online marketing. It's an online advertising omni-channel with audio-based advertising for Spotify, Pandora, SoundCloud, etc., as well as connected TV. This is TV advertising, but with many of the controls modern internet advertising has. The top line is growing over 40%, and they're still profitable. While its 143 PE ratio may sound expensive, remember, most companies growing at this rate are losing money. The Trade Desk is achieving this blistering rate of growth while still maintaining 20% operating margins.
House of pleasure.
And last but not least, Twilio. Twilio is best known for providing software which enables companies and their customers to easily text one another. Here's one example. Twilio allows Lyft customers to text their driver with a temporary phone number. That way, if your driver ends up being a creeper,
Don't be jealous that I've been chatting online with babes all day.
you don't need to worry. Twilio is the fastest growing stock I own, with the top line growing 63% last year and 86% last quarter. Its dollar-based net expansion rate is 140%, which has actually accelerated from 137% a year ago. Dollar-based net expansion rate is the revenue earned from existing customers compared to those same customers a year ago. So for every $100 customers were paying Twilio a year ago, those same customers are now paying Twilio $140.
That was easy.
On the downside, Twilio's operating margins are negative 28.4%, and they have diluted shares by over 34% in the past 4 quarters alone. In spite of this, I think paying 20 times revenues makes sense for these numbers. That's it for this video. Hey guys, I'm trying my best to help contribute high quality, entertaining investing content to the YouTube community. If you'd like to support that effort, it would really mean a lot to me if you subscribe. Plus, I guarantee Investomania will be your favorite investing YouTube channel or your money back. I mean, you didn't spend any money, so...